Most traders believe they are losing money because their strategy is bad. They think they need a new indicator, a new system, or some secret strategy that professionals are hiding. But the truth is much simpler and much harder to accept. Your strategy might not be the problem, your timing is. The difference between a profitable trader and a losing trader often comes down to one simple skill: when to enter, when to wait, and when to stay out of the market completely. Today we are going to break down why bad timing destroys traders, and how fixing it can completely transform your results. The illusion of constant trading. New traders believe they must trade every day. They sit in front of the charts waiting for something to happen. The moment price moves quickly, they feel like they are missing an opportunity, so they jump in. But the market does not reward impatience. It rewards precision and patience. Professional traders might only take 2 or 3 high-quality trades in an entire week. Beginners try to take 10 trades a day, and that difference in timing changes everything. When you force trades, you enter during random market movement instead of high-probability setups. This is the first timing mistake most traders make. Trading at the worst possible moment. Have you ever noticed something strange? The moment you enter a trade, the market suddenly reverses. You buy, price drops. You sell, price shoots up. It feels like the market is hunting your stop loss. But in most cases, the problem isn't manipulation. The problem is late entries. Many traders wait until a move is already obvious. They see a strong bullish candle, panic that they missed the move, and finally enter at the top. Professional traders did something very different. They entered earlier, during consolidation or before the breakout. By the time beginners enter, smart money is already taking profits. That's why timing matters more than strategy. The problem with lower time frames. Another major timing mistake comes from trading extremely small time frames. Many beginners spend their entire day staring at the 1-minute or 5-minute chart. These charts are full of noise. Small price fluctuations create the illusion of opportunity. But most of those movements are meaningless. Professional traders understand something powerful. Bigger time frames control the market. The 4-hour chart, the daily chart, and sometimes even the weekly chart. When you trade based only on tiny time frames, you are reacting to random fluctuations instead of real market structure. That leads to poor timing and emotional decisions. Patience is the real edge. The biggest difference between amateur traders and professional traders is patience. Professionals understand that the market only provides a few truly high-probability setups. They wait for those moments. Sometimes that means watching the chart for hours without placing a single trade. Most beginners cannot tolerate that level of patience. They feel the need to act. But in trading, doing nothing is often the most profitable decision. Good timing requires discipline. You must learn to wait for the market to come to your level, instead of chasing the market. The power of trading sessions. Timing is not only about entries. It's also about when you trade during the day. Markets move differently depending on the session. The London session often creates strong volatility and breakouts. The New York session can continue those moves or reverse them. But during quiet hours, price often moves sideways with unpredictable spikes. Many traders lose money simply because they are trading during the slowest and most unpredictable hours. Professional traders focus on specific windows of time, when liquidity and momentum are strongest. When you align your trading with those periods, your timing automatically improves. Waiting for confirmation. Another timing skill is waiting for confirmation. Many traders try to predict every move. They enter before the market clearly shows direction. But prediction is not the goal of trading. Confirmation is. Instead of guessing where price might go, experienced traders wait for the market to prove its intention. They let the structure form. They allow support and resistance to hold. They watch how price reacts. Only then do they enter. That patience dramatically improves timing. The simple timing rule. If you want to improve your trading results, remember this simple rule. If the trade feels rushed, it's probably the wrong time. Good trades rarely feel chaotic. They feel clear. The setup forms. The level is obvious. The risk is defined. And the entry feels calm, not emotional. When your timing is right, trading becomes much simpler. Conclusion. Most traders spend years searching for the perfect strategy. They switch indicators, change systems, and constantly chase new methods. But the truth is that many of them already had a working strategy. What they lacked was timing and patience. The market rewards traders who wait, traders who observe, traders who strike only when the opportunity is clear. So the next time you feel the urge to jump into a random trade, stop for a moment and ask yourself one question. Is this the right setup? Or just the wrong timing? Because fixing your timing might be the single change that finally turns your trading around.